Welcome to RenMac Off Script. We're able to discuss markets, economics, policy, history, and life. It's the 26th of January, 2024. I'm Jeff DeGraff.
I'm Neil Dutta.
And I'm Steve Pavlik.
As a reminder, all the charts that we reference are posted to our Twitter account and RenMac LLC. We're going to hit today on obviously the GDP numbers this week, what's up with Haley, and how the pollsters are feeling, or I should say the electorate is feeling about the economy via the polls. Did get or very close to a dark cross in some of these important yields and some of the sentiment data that is out there. Let's start with Haley, Mr. Pavlik, and her prospects here going forward. Slim, none, or even worse?
Well, it depends what job you're referring to. In terms of president, they're definitely none. I think if you talk about vice president, maybe slim. I guess that's the only real reason that she's staying in the race, in that she's trying to make the argument to Trump. Basically, I have the support of the anti-Trumpers. I can appeal to suburban women. That's where you're presumably the weakest in terms of polls. So you should pick me. I think we mentioned this last week. I'm not sure he's going to be receptive to that argument. But look, I mean, she lost the tailor-made state for her. And it was even more that way because Democrats didn't have technically a competitive primary there. So even the Democrat leaning unaffiliated voters had more incentive to participate in the Republican, which meant, it was, again, even more favorable to her. If you lose by 11 points in New Hampshire and you're down 30 points in your home state, I don't see it.
So two things that really come out here. Who is going to be number two? Does she have a real shot? You say it's slim. If not, so who do you see as being the rightful and maybe best candidate for the Trump campaign as number two?
Ordinarily, when you think about a vice president, that is somebody who's supposed to augment what you perceive as your political weakness. If you look back at 2016, Trump was struggling to gain a lot of support from social conservatives. That's why Mike Pence was attractive as an option there. I don't think he has an issue with them based on what we've seen so far in the primaries. So my guess is he's focusing on suburban women. My two picks for him would be either Sarah Huckabee Sanders. She's the governor of Arkansas. You might remember she was also Trump's former press secretary. I think that's important because she has not only a working relationship with Trump, but in that role, she defended him in front of the press, which is essentially what most vice presidents are going to be asked to do. So to me, that's sort of a no-brainer. I think he's probably considering Senator Tim Scott. I think from that perspective, he could be attractive to suburban white voters who might push back against claims that people are racist. Well, no, he appointed Tim Scott, so I'm okay. And then I think just having that relationship with Republican lawmakers isn't necessarily a bad thing. And he's somebody who's held pretty high regard. And just from a contrast in styles, he's more the happy warrior, which is sort of a definitely contrast in terms of Trump most times on the campaign trail.
Yeah, definitely. How's Huckabee's record been down in Arkansas? She popular? Where she divisive? I haven't heard much about her.
She's a lot more popular than the former governor, Asa Hutchinson, who didn't run very far in the Republican presidential race. It's a conservative state, and she's pretty conservative. So, I think for the most part, she's done a good job. And I would just add, if you're a governor of a state, I think that's somebody who could, presumably step into a role. I know there's been a lot of talk about Elise Stefanik after she sort of led the charge against the university presidents and their lack of any coherent explanation for the positions they claim to be taking. And I think the concern there, from my opinion, would be, congressmen or congresswomen in this case. I don't know that, they would necessarily step in to fill that role compared to a governor who actually has run a state. And
yeah, Stefanik had her 15 minutes. I mean, move on, right? Yeah.
Well, the thing to watch to that point is these people they're all auditioning right now, and that's why you see them going on the Sunday shows. And each of those people I mentioned were on the Sunday shows last week. I guess as you're going to see them moving forward, and that is not lost on Trump, who really prides a lot of his cabinet position picks. I say this as somebody who was involved with that process on how you come across on TV. So,
and in terms of the polls, people are less than satisfied with the economy right here. Is that the biggest issue?
Well, we have a Pew study out that, I think was interesting. You have a lot of good economic news. I'm sure, we'll touch on that. And, I've seen a lot of the gains in terms of maybe improving a little bit. Most of those gains in the polls are coming from Democrats, which shouldn't be surprising. I think, greater polarized environment, people are returning home, want to give Biden more the benefit of the doubt. But the concern would be, right now you have a lot of the independents still siding with the Republicans here. And you see, concern over price of food and consumer goods relatively flat, cost of housing concerns going up, but the price of gasoline and energy is coming down. So I think that's the thing to watch moving forward, as well as just, if the economy continues to move in the right direction, are voters going to get there in time? I think of 92 and George H.W. Bush. The economy started to improve there towards the end, but he didn't win re-election. There was a third party threat there. There could very well be a similar third party threat this time. And are we going off a 1 year application where, wages, I believe Neil could tell you more, are maybe improving compared to inflation over 1 year, but are people applying that 4 year standard? It goes back to Ronald Reagan. Are you better off today than you were 4 years ago? And 4 years ago, a lot of voters, based on just a lot of the inflation his first 2 years, may not feel that's the case.
Yeah. So, Neil, we had the GDP numbers out this week. They were better than most expected. How'd you interpret it? And I think importantly, what is the messaging from inflation and the forward outlook for inflation given those GDP numbers?
Well, I mean, looking at the 12-month rate of inflation, core inflation, PCE, is 2.9%, so it's below 3%. But I think that sort of overstates things, because if you look at it over the last 6 months, over the last 3 months, it's been running below 2. Believe it or not, core inflation over the last 3 months is running just 1.5% at an annual rate. So what we have is a better composition of growth. And that was evident in the GDP number for the fourth quarter. We saw solid growth in excess of 3%. Keep in mind that at an annual rate, that happened despite a negative contribution from motor vehicle output, right? Because of the strikes. So that's probably going to come back in the first quarter. So we sort of have a and when you think about private domestic demand, so GDP net of trade, inventories, and the government, that was at a little over 2.5%, right? That kind of measure is a useful one to tell you about next quarter growth. So it kind of puts a floor on activity, in my view, for the first quarter. Steve mentioned the 92 election. I mean, one of the things that happened during that period was that the unemployment rate was rising from 1990 all the way through the middle of 1992. Right. So that's not happening right now. We've had some increase in layoff announcements, but like last January, it seems to be largely concentrated in the tech industry. Obviously, the scale seems a little bit smaller, but the unemployment rate more broadly is still below 4%. That's encouraging, I think. And real incomes are picking up, and consumer sentiment's picking up. Right. I mean, if you look at the University of Michigan Consumer Sentiment Index, it's been climbing. And one of the reasons why it's climbing is because consumers are telling us that their, short run inflation expectations are coming down. So that's all good. Whether the incumbent can capitalize on that is, remains to be seen. But the news, I think, is improving. And obviously you can speak to which way the stock market's going, but
Yeah, I mean, look, we're getting dark crosses in a lot of the longer term rates, right? So in other words, on the yields. So the path of least resistance, and this is not a perfect signal. Don't, let's call it what it is, which is an indication of what the path of least resistance is, and that can change, but it's not that it's that predictive. It really just tends to be very good at setting yourself up for big winners, and when it's wrong, small losers, and that's really what ends up happening. So this idea that the dark cross in yields is taking place is really again not about being predictive, but just saying, look, the risk now is that there's a lot more downside to yields than there is upside, and if there is upside, then those those indications will definitely change. It's interesting, the auto side of the equation, because they've been weak, and there's been a lot of, from the demand side and the supply side and used car prices and everything else. You would think that this would really be um, a pretty good environment for autos generally, and the manufacturers have not been good in our work for a long, long time. What's maybe most interesting here is that Tesla is starting to crack. You saw the gap down. It's been weaker in our work. We had a deep oversold condition here right now. So I do expect tactically that we'll get some type of bounce out of Tesla. However, that is within the context of a much larger, longer term top formation that really spans something like 3+ years, taking us all the way back to 2020. And it has downside objectives that are 150, 100 on the downside there. So, clearly we're seeing some weakness in that part of the market structure. The other side of it, and I want to get your take on this because I don't think there's anything in the data, but in our SERM ranking, which stands for Standardized Excess Return Model, we look at home builders and the home builder returns. And keep in mind, most of these turned bullish for us back in the summer, late summer of 2022. So it's been a year and a half now that our work has been positive on this. But the excess returns that we're seeing at a home builders has reached the stage that historically implies their ninth inning. Now, by itself, that's not a sell. It's a lot like valuation that can go on. It can persist. So we wait for relative performance cracks. But we did see some negative volatility alerts this week from Horton. Obviously, that infected some of the other names within the space. What are you seeing out of home builders, Neil, and the data, whether it's through traffic, the sentiment around home builders? Anything there that would suggest that there's a warning sign or a crack in the structure?
Well, I don't know that it's a crack in the structure. I mean, I think new home sales are climbing. We've seen builder sentiment pick up. But what's interesting is that mortgage rates jumped a lot, and during that period, home builders did phenomenally well, right? Which is sort of counterintuitive, obviously. But what happened is the resale market completely shut down as a result, because you had people locked in at low interest rates and they have no incentive to list their house. And that means that single family builders can gain a lot of share in the market, which is what happened. And it could be almost perverse in a way, because if you're right about the path of least resistance is for lower interest rates, that could have the opposite effect now, where builders are now needing to compete with a unlocking of resale inventory. And so as a result, their share in the market might come down. And maybe that's what the markets are kind of responding to. So it's a little counterintuitive. I mean, I think it's obviously lower rates are still going to be fine for builders. I mean, builders would rather have lower rates than higher rates, and particularly lower rates with people employed. So it's not, it's okay, but I'll put it to you this way: maybe it's a better scenario for real estate agents than home builders. How's that?
Right. It's good for the overall traffic, but the product mix might not be as bullish for home builders as otherwise. A couple things just to note. The investors intelligence, we put this in on our Twitter feed. Obviously, clients see it in a more timely manner, but the investors intelligence bull bear data actually contracted in the last week. So it's not as if as we go on to make these new highs, we're seeing more and more optimism feed into the sentiment data. That will happen at some point, and sentiment will become, probably one of the keys to helping to assess the risks for forward returns for equities. But again, the important part of sentiment is that you need it to be ubiquitous. It's not just this indicator or that indicator. It actually ends up being the confluence of these indicators coming together and giving you some type of signal. I would say, though, a couple things jump out to me. One is what we're seeing in some of our option work, which is on individual securities, where we can assess what the demand for exposure is to the upside versus downside. And we are seeing extremes in some of these tech names. Now, it might not be the ones that you would think. Broadcom would be one, Synopsys would be another, Cadence Design would be another, where the option positioning is suggesting that people are really kind of scrambling over themselves to get upside exposure. And historically, when we have that with momentum, which we have, that's a dangerous sign that you're probably going into a pause. So I do see it for these pockets in tech that I think are notable. The other side of that coin, which I think is interesting, is China and what we see out of the sentiment in China. The CQQQ, which is Chinese technology names, actually on a 65-day basis for our ETF flows showed extreme outflows, excessive outflows, which is good news. It's a great setup. We've obviously had a bounce with this idea that they're going to try to provide some type of stimulus to the markets. We'll see how enduring that is. But, when you get these initial surges, you generally want to play them versus fade them. And I think the sentiment setup is actually quite bullish there with what we're seeing out of the particularly Chinese tech and the flows there. So seeing that dark cross for rates, looking for these rates to be a little bit more of a tailwind than a headwind. For the equity markets, I think is good news, not bad news. We did see breadth confirmation from the Russell 3000 yesterday in terms of the trend of breadth that's already been engaged and locked in as an uptrend for the NYSE breadth, which tends to be more important and more predictive. So that's just confirmation, nothing new there. But things are generally looking to be in a pretty good space, with the exception of just some of these pockets of excess that we're seeing in the option market, particularly for technology names. Neil, what do we have on the docket next week in terms of data?
Well, it's a busy, busy week. We obviously have the Fed meeting on Wednesday. That's on the 31st, where it's widely anticipated that they'll be on hold. I don't think that they're going to rule out March. I don't think that they'll rule it in either. So it'll kind of keep the probabilities, 50-50, which is sort of where they are now. But before the Fed meeting, we will get the employment cost index. I think that's an important one to watch because it does suggest, I think what we'll see is continued evidence that the labor markets have basically rebalanced. And that's important for the Fed, ultimately, if they want to achieve their inflation goals. We'll also get data on the ISM, manufacturing PMI to end the week, and employment. Now, remember, this would be a January number. There's a weird, seasonality goes on with January, and we got a big upside surprise in employment last January, so we'll see what happens next Friday. But right now, the consensus for employment is 180,000 for January. Still, that's fine. In terms of jobs growth, with hourly earnings rising just 0.3%. I'm going to be watching hours in particular because I think that's going to be the first thing to adjust if we're right about the direction of manufacturing. I mean, we've seen just an unsustainable inventory drawdown, and ultimately inventories need to be replenished. And when that happens, manufacturing needs to pick up to deal with that. So, the first sign you'd see it is in the work week.
And Steve, out of Washington, what's the latest in terms of fistfights in DC?
Well, we had some optimism, I think, last week regarding a potential bipartisan border deal. Now, personally, we were always sort of skeptical over that, and also prospects of maybe the $78 billion tax stimulus moving. If I had to describe, the sentiment right now in DC, I'd say it's gone from hope to nope. In that, from the border prospects, I mean, Donald Trump has weighed in, and I thought Neil made a really good point prior to our taping this, which is, Trump was able to do a lot of the border policies without legislation. So I think, from his standpoint, he's probably wondering why Republican lawmakers want to maybe give a bipartisan win for Biden ahead of the election, when presumably he could just use a lot of the same executive actions that he did. So that's something to watch, because that also impacts whether it's going to be any additional aid to Ukraine. Speaking of Ukraine, I thought it was interesting that the Biden administration is going to halt LNG exports. Watch that European coalition, because right now a lot of those exports have been going primarily to Europe. In addition, Qatar, who's sort of the second largest producer after the U.S., saw a January report from Reuters that because of these Houthi attacks, they're not shipping any gas right now. So, again, but in terms of domestic prices, I guess if we're not sending anything abroad, domestic prices will come down, probably not shocking ahead of the election. And then on that $78 billion tax deal, you have the Senate saying they want to go ahead and mark this bill up. So you're definitely slowing it down. That means if you're not going to get it before April 15th, for those looking to try to get the potential credits this year on their tax filing. That's impactful. And just the prospects, if the Senate starts altering it, there's real concern whether or not it would even move in the House. You have Republicans sort of pushing for work requirements. That's not going to go over with Democrats that want to expand the child tax credit. So gone from probably more optimistic that it would pass to now sort of skeptical whether or not it will. So if I had to put a probability, maybe 60% moving before, probably down to 40. So that's sort of what I'm watching.
Gridlock at its best. Well, we'll certainly be keeping our eyes on equities. Cyclical versus defensives did make a new high here most recently as of yesterday, which is good news, particularly as these bond yields have risen in the very near term, because it says that they're not really crimping or cutting off that excessive growth. So no targets. When you make a new high, it's hard to put a target on that. What we can do is triangulate what we saw from some of those momentum, thrust, and escape velocity indications that we had in the fourth quarter. 48.18 was the resistance zone. We're above that, obviously, puts 5,800 in the crosshairs in terms of upside targets with the historical precedent of what we've seen from the other escape velocity scenarios in the marketplace. Join us again next week. We'll be 1 week older, 1 week wiser. Don't forget to follow us on Twitter and RenMac.com. And if you like what you're hearing, but you're not an institutional account or client, feel free to go to RenMac Access. That's RenMacAccess.com and get some of the insights that we're talking about here today. Until then, I'm Jeff DeGraff.
I'm Neil Dutta.
And I'm Steve Padley.
We'll see you.